Welcome to ECCB Connects, a production of the Eastern Caribbean Central Bank designed to share with you who we are, what we do, and how we serve you. Have you ever wondered why external auditing is important? Why should customers pay attention to the financial statements produced by a company or a financial institution? In this episode, we speak with President of the Institute of Chartered Accountants of the Eastern Caribbean, Andrea St Rose, and she shares with us how external auditors provide an independent verification or assessment of a company's financial statements. Stay connected with us. We'll share more with you after this break.
Celebrating ECCB at 40.
Did you know that the agreement establishing the Eastern Caribbean Central Bank was signed on July 5, 1983 in Trinidad and Tobago by 7 member states? Now you know, celebrating ECCB at 40.
Andrea, welcome to ECCB Connects.
Thank you, and thank you for inviting me to this interview.
External auditing is a process usually where an independent body, an accountant, comes into a company to do an examination of different processes, financial statements, etc. And some people may have heard about it, but are not quite familiar with what it is. Why is external auditing important, particularly in the context of the financial institutions that the ECCB regulates?
First and foremost, an external auditor needs to possess certain qualifications before they can actually engage in conducting an audit. The auditor must be licensed by the Institute of Chartered Accountants of the Eastern Caribbean for purposes of audits of financial statements within the region. There are certain standards that must be followed as well with respect to the manner in which the external auditor will conduct the audit work. These are referred to as international standards on auditing. In addition to that, there are certain qualities and from a quality perspective that must be adhered to. And these are referred to as international standards on quality management that the auditor must follow. So taking all of this into consideration, the external auditor now provides an objective and independent review of the financial statements that the company has prepared. And as such, it gives shareholders and other stakeholders some level of comfort that the opinion that the external auditor is presenting makes sense. They can rely on that opinion with respect to the financial statements.
And of course, the financial statements outline, how a company is doing, what profits were made, where the money was spent,
exactly.
If any losses were incurred.
Exactly. So the financial statements contain certain major components, and one has to be the balance sheet, referred to as well as the statement of financial position. And really what this statement shows, it shows the assets that are owned by the company, as well as the liabilities, meaning monies that the companies own that is due to third parties. And there's also the section on equity, which really is what is the remainder that really belongs to the shareholders of the company. In addition to that, there's a statement of operations or statement of income that is also presented, also referred to as the statement of profit and loss in some jurisdictions. And it really reflects the revenue that has been generated by the entity, the expenses that has been incurred, and the net profit that has been generated. And net profit is also important because it gives an indication of the amount that is available for distribution to shareholders in the form of dividend payments. Then we have the statement of cash flows, which really shows how did the company generate incoming cash flows and what did it use those cash flows for. So this is a very important statement because it may be the case that a company is showing profits, but there's no cash flow. And even when a company is making profits and there's no cash flow, it can put the company into financial difficulties. So this is a very important document that investors, stakeholders need to pay attention to. Very importantly as well are the notes to the financial statements, because the notes provide the additional information that the main statements would not pick up. For example, the disclosures would speak to, say, any potential liabilities that have not been recorded in the financial statements as a result of uncertainties. It also provides information about the risk management activities undertaken by the entity. So it is very important that stakeholders have a look at the disclosures in the financial statements when they look at the main statements, because as a whole, it provides the complete set of financial statements. With respect to the opinions that the auditor will generate, there are 3 types of opinions, basically. And it is important that users understand what these opinions mean. At the end of the day, the opinion is really what you're paying the auditors for. So there is what is referred to as the unqualified opinion, normally referred to as a clean opinion. It says that whatever is in these financial statements, we endorse it, it is fine, it is fairly stated in all material respects. And when we speak to material respects, we want to say that it is not down to the last dollar or the last cent or the last, we establish what we refer to as a level of materiality, in that the amount that would affect the decision of the user. And so we would say that these financial statements are fairly stated in all material respects in accordance with the underlying standard. We also have an opinion that we refer to as adverse opinion. And in that adverse opinion, we would probably say that, the financial statements are not fairly presented because of A, B, C, D, E. We also have a case where we would issue a disclaimer of opinion. And in that disclaimer, we would say that based on all the problems that we encountered when we reviewed these financial statements, we are unable to determine what adjustments would be necessary. So we are not providing an opinion on these financial statements. We also have a case where we issue an except for, where if it is the case that there are some differences, but it is not significant enough, we will highlight that particular area of the difference and quantify it and say, except for A, B, C, D, E, the financial statements are fairly stated in all material respects. So it is very important that the opinion, be looked into when it is issued.
Tell us what exactly the process of conducting an external audit entails.
First and foremost, the most important part of conducting the audit is the planning of the engagement. As part of the planning of the engagement, the auditor would engage with management to get an overall view of what has happened in the business, for the period under review. And ideally, it is done before the year end. Yeah. And then we look at the controls that they have in place, confirm the understanding of the controls. The controls are all those activities that are undertaken by the entity to make sure that the underlying figures in the financial statements are proper, they are properly authorized, they are complete, and they are accurate. So we look at those controls as well. But prior to that, there's also an engagement with those charged with governance, which would, in most big institutions, the financial institutions, it would be the audit committee and then the board, where we discuss the approach to the audit, how we plan to do the audit, the timelines, we agree on the timelines, etc. Having done that, when we go into the field to do the audit, the first thing that we do is to establish that there is a proper system of internal controls. Because as you can appreciate, the auditor cannot go through every single transaction that the entity would undertake, right? So we establish a set of, we review the internal controls, and if we are satisfied that the internal controls are operating effectively, based on the work that has been prepared, when we test those controls, we place a certain reliance on the system and then do what we refer to as sample testing of the underlying transactions. And of course, when we come to the section of the balance sheet, etc., we will do our regular validation of the balances in there, get confirmation. So if you say you have investments of $10 million, we would confirm with the third parties that really these amounts are fairly stated in the financial statements. Your bank accounts, we look at your bank reconciliations. You say you have property, plant, and equipment. We'd want to see the title, that you have title to these, to these properties. We want to make sure that the additions that you are showing are properly reflected in the books, etc. So it's a question of validating this. This is what you have said, but this is what we will carry out procedures to ensure that what you are reflecting is correct.
Andrea, so who determines how far the validation process or how much of what a company has is examined? For example, if I decide, I'm inviting you in because the company has to invite the external auditor in, who decides how far the examination goes?
Okay, so then that would be the external auditor would determine that. And this is based primarily on an assessment of the internal controls, an assessment of the changes that has taken place in the business during the period. Say, for example, if you've had an upgrade to your software, we would want to place, emphasis on the controls that you had in place when you move from one system to the next system.
Now, what is the benefit of the external audit to the customer who is interacting with this particular company? And even before that, what's the benefit to the company itself to say that they've been audited?
Certain institutions are required to be audited, in particular financial institutions. So the first thing is that for the financial institution, you are in compliance with the required, legislative, requirements. And it gives it would give the company a certain level of comfort that someone independent of management has gone through and has had a look at the information, the underlying information that comprise the figures that are reported. And the comfort is that, yes, these figures are fairly stated. And so we can pay a dividend to our shareholders, for example, without running the risk of liquidity issues, etc. And it also would give comfort to customers that I am investing in a bank that is healthy, for example, that yes, they say that they are making profit of so much money that is being reinvested in the business. And I get comfort that, today or tomorrow, there will not be a run on the bank because the monies are not there and people get jittery. And so it gives them that level of comfort that my deposit is safe in the bank.
What would you say to customers within about how they interact with the financial statements and understanding the audit experience of their institution?
It is very important that the ordinary man understands the information in the financial statements. Where you have a financial institution that shows a deficiency in the equity section of the financial statement, it means that that company cannot meet its liabilities. So that is what we refer to as a red flag. So you want to ensure that you are dealing with a financial institution that has equity in there, right?
So that in that they have enough collateral, whatever it is, cash to take care of their obligations.
To take care of the obligations, as well as some cushion in the event that you have some problems in the future to deal with. You want to make sure that this is the case. It is very, very, very important that they look at the balance sheet and they look at the statement of cash flows. These are two very important documents that should be reviewed. They also, depending on the level of sophistication, they may also want to make sure that when they have a look at the notes to the financial statements, they gain an understanding of the risk mitigation activities that the company would undertake. And when I speak about risk, it deals with things that can go wrong. I'll speak of what we refer as the negative side of risk, right? Things that can go wrong. And what is it that the company is doing to deal with those risks? For example, you may have the issue of interest rate risk. Interest rates can go up and it can go down. They can always sit with someone at the bank to say, can you walk me through this financial statement so I can gain an understanding as to what is happening at the bank?
What are some recommendations you'd make to a company as they prepare to undergo an external audit?
So first and foremost, you need to have a meeting with the external auditors as soon as they have been reappointed or appointed, as the case may be. Then you would establish a timeline with the external auditor in terms of the activities that will take place leading to the audit. The planning, the on-site visit, the submission of information, the financial statements roll forward so that you have a shell to work with. So by the time you come to populate the financial statements, all the disclosures are there already. So you're not spending too much time going through to see, okay, what standards have changed. All of these things are done in the interim period prior to the year end. It is very important that any significant change in the business is brought to the attention of the external auditors immediately. So then you can start to have a plan of action in terms of what it is that will be doing to address those issues, because otherwise there will be protracted, the audit will be protracted, you get delays as you try to get things resolved. So it is very, very, very important that we establish the schedule in terms of meeting with the parties and to highlight significant changes that may present some challenges in terms of how they're dealt with as part of the audit process. Planning is key. Communication is also key.
Andrea, thank you so much for speaking with us, for explaining why external audit is important, especially in the context of our financial institutions in the region.
Yes, thank you.
EC Polymer Notes, our new money.
Here's how you can detect genuine EC polymer notes. Feel. Polymer notes feel smoother than the material from which paper notes are made. Also, the front of each note has raised bumps at the top left-hand corner. These bumps form shapes that are familiar to you. Look for the clear window at the front and back of each note. This window allows you to see through the notes. If you hold the notes up to the light, you'll see the value of the note in an area of plain colored print. Tilt. A holographic foil is on the $100, $50, and $20. The images move and their colors change when you tilt the notes. Remember, detecting genuine EC polymer notes is as easy as 1, 2, 3. Feel, look, and tilt.
EC Polymer Notes. Cleaner, safer, stronger.
We're at the end of this episode of ECCB Connects. We spoke with Andrea St Rose, President of the Institute of Chartered Accountants of the Eastern Caribbean, about external auditing. She shared that for some companies, having an external audit performed is a legal requirement, and that this should be performed by a licensed and qualified auditor or firm. Customers should pay close attention to the company's financial statements to get a sense of its assets and liabilities and to understand how the company is performing. Thanks so much for watching this episode of ECCB Connects, and be sure to join us next week when we bring you another program to share with you who we are, what we do, and how we serve you.